Hello, I'm Robert and welcome to my channel, where I discuss everything automated algorithmic trading, or simply algo trading. Today's video is going to be a fun one, and one that has taken 2 years to get here. Today I'm going to talk about Jackrabbit Relay's conditional orders. This has been a nightmare to build, but one that was so well worth it. The results are absolutely phenomenal, and the control it gives over a particular order is one that is unparalleled to any other approach. It also helps double the number of alerts that you can use within TradingView. Normally you have to have one buy alert and one sell alert. With conditional orders, you only need the buy alert, and Jackrabbit Relay takes care of the selling based upon a specific take profit and a stop loss. We are going to go through the mechanical process of what you need to put in your TradingView order or other REST API order framework to use this process. For the purposes of simplicity, we are going to assume TradingView is the mechanism that you are delivering these orders to. Now, the purpose of conditional orders is that you let Jackrabbit Relay manage the order completely. It's kind of a hands-off approach, and either take profit or stop loss, it will deal with it. So let's get right into the actual order framework. First and foremost, this does not change the base level of the order, which we will see in examples in a few minutes. What it does do is add an additional layer to the order that gives you the ability to process the order through Relay directly, and specifically through the Oliver Twist order manager. So we have the basics here on the screen for what is capable and required within the order. Let's get straight into examples. The first example is for a cryptocurrency exchange, and there are a lot of different situations that you need to be aware of with cryptocurrencies that become extremely difficult in the long term, but they are managed automatically by Jackrabbit Relay. So here we have on the screen a simple order. It's a very basic one with the conditional part highlighted. You must tell Relay that this is a conditional order. That is what the conditional yes functionality is. Because Relay doesn't know or understand what direction you want the order to go in, you must explicitly tell it through the direction item that this is going to be a long order or a short order. And you tell it through a sell action. How will it dispose of this particular position? Will it sell only this position, or will it close out the entire position at one time? And then you have your take profit of 1%, where it will get the actual price from the exchange and determine a 1% take profit. Here I am using a 20% stop loss, so that if the market goes down 20% for that position, it gets out of the order. Of course, the identity is required throughout Relay no matter what. As far as the numbers, 1%, 20%, there's a lot of research that goes into that. And I will discuss that a little bit later on, as it is much more involved. So this is the basic part you need to turn any order into a conditional order. Now it's important to understand that this does not work with the DSR, nor is it really needed. At this point for the conditional order, your strategy should be so fine-tuned that a duplicate order from TradingView isn't an issue. And there are ways that Oliver Twist will deal with any duplicates coming out of TradingView, which is our next example. And this is the proper way to use a cryptocurrency exchange for profitability, because it deals with the fact that all cryptocurrency exchanges track only the average of the wallet, not the individual positions. So if you try to trade multiple positions through the course of sells and losses, you will end up in a situation where you will not have enough money in an account to sustain an order you have placed, because the average will be below what the order was placed at. The conditional one-shot approach addresses this issue directly. And that is, it tells the whole system that only one single position for this asset is allowed. That's it. Any other orders coming in are to be ignored. So you'll see that on the second line in the blue box, conditional one-shot yes. This is really the best and most profitable way of dealing with cryptocurrency exchanges that don't explicitly use a direct accumulation approach like Jackrabbit TV. If you're going to use a stop loss, do not try to use accumulation at the same time, or it will turn out to be a very big hot mess. I spent 2 years studying this to analyze it to determine exactly why that is. And as I just said a few minutes ago, cryptocurrency exchanges only track the average. They do not track individual positions. So if you made 1,000 purchases of Bitcoin, all the exchange is going to see is one single number. And any orders you've placed will be subject to that one single number, which is the account average. So this is the best way to trade a cryptocurrency exchange if you want to use conditional orders that do not rely on an accumulation approach and specifically focus on a stop loss technique. And of course, conditional orders work with OANDA, and Forex is the same way with some slight differences. Now with the Forex markets, you'll see that enforce FIFO is there. If you're dealing with Forex, most of the time you're dealing with a jurisdiction that requires a first in, first out regulation, where if you have two positions that have the exact same amount, the oldest position has to be sold first. That is a problem jurisdictionally that this fixes. This will make sure that no matter what the unit size is, it will actually inspect your units from your trades, and then it will increment it by one to make sure that you are safely within the FIFO regulations of that jurisdiction. The other thing you want to pay attention here is take profit and stop loss are listed in pips. That's what the letter P is on the end. So this is using a 5 pip take profit and a 161 pip stop loss. So very simple, very easy mechanical process. And this really is one of the best ways of managing trades with Oanda. It's a beautiful way to go. It does exceptional, and it really brings home a good profitability. So now let's get into the details of the data, your stop losses and your take profits. How do you get those numbers? What data supports those numbers? That is a difficult question to answer and one that required a lot of research. If you're a subscriber to my Patreon, or if you're a sponsor to the supplemental Oanda information, you will have a very large amount of information to base your decisions upon. And I'm going to talk about that next. Right now, I am in the Supplemental Repository for the KuCoin Exchange, and I'm going to pull up one particular area. Let's go into the 1-inch asset, and for every single time frame, I have collected data, 5,000 candles for each and every time frame supported by this asset, so that I can run an analysis to determine the best and most profitable approach. Now this takes a significant amount of time to process, and I've blown up my VPS quite a bit just within the last 3 months of developing and refining this technique. These files are based upon a take profit range of 1% to 30% and a stop loss range of 1% to 50%. Numbers that I collected over the last 6 months from what people have actually been using within the market. So let's go to a 1% take profit, 20% stop loss. As I found from my own personal trading, that tends to work well. And we have a report that goes through and actually simulates the trading process appropriate to this time frame, pulling down 5,000 candles. So you see, I started this simulation with a $1,000 balance, 2% of my balance per every single trade. This is the 1 hour time frame, and the duration of that time frame is 62 days and 11 hours. My take profit is 1%. My stop loss is 20%. My reward to risk ratio is 0.05. Or take profit 1%, stop loss 20%. So if my take profit was 1% and my stop loss was 1%, then my reward to risk ratio would be 1. And I'll demonstrate that in a few minutes. My win to loss ratio is 16.5. So now let's actually look at the individual simulated data. And I'm going to describe the testing process I used. So here we have simulated trades. We have on the left-hand side the buy asset approach. That is all of the information of how I took that trade. And the process I used to take that trade is very simple. If I wasn't holding a position, I simply bought the next position available. I didn't use any strategy because I didn't want this to become an analysis of the strategy itself. I may in the future go through different strategies repeating this test, showing how a MACD would perform or how Bollinger Bands would perform, but I wanted a very simple approach just to demonstrate the differences between take profit and stop loss and to illustrate the dynamic correlation between both of them, and the fact that a tight stop loss isn't always the best situation to be in, and in fact can cause you more losses than what you really should take. There is a lot of information in these tables, so let's go through and really talk about that information. Each one of these are broken up into a column, with two major columns throughout the entire table, the buy side and the sell side, the buy side being on the left. So on the left hand side, the buy side, date time is the time that this purchase took place. The amount is 44 of 1 inch based upon 2% of my total balance. My stop loss calculations for a 20%, the actual price I purchased it, and then the take profit of the 1%. Very simple table on the left hand side. It just shows where I got in the market and what I actually spent getting into the market. Now this demonstrates compounding of one position at a time. I purchase, I hold it until I either take profit or I get stopped out, and then on the next candle I purchase again. Very simple technique, very easy technique to demonstrate. So now let's move to the right hand side, the sell system, the date and time that the asset sold, the trigger price of that sell. An SL is a stop loss was triggered, a TP is a take profit was triggered. As you can see right here, the very first entry is a stop loss. That means I lost money. You can see here the amount I lost and the resulting loss and how it affected my balance. Finally, over here, how long did I hold this asset? What was my holding time? This particular position I held for 29 days and 17 hours. And it repeats that all the way down, where you see a take profit, stop losses, the actual running balance, and then the actual holding time that I held a particular asset before I either stopped out or I profited it. And the thing to remember, which I've said in previous videos, statistically, it's easier to reach 1% than 20%. So if your take profit is higher than your stop loss, by whatever that difference is, you have a situation of being more likely to be stopped out. For example, a standard or common risk to reward ratio is 2 to 1. So for every loss you take, you make 2 times the profit. The problem with that is you are likely to take twice as many stop losses because the stop loss is closer to your purchase price than your take profit. So these tables actually show you the correlation and the benefits on a wide scale in terms of what really does work, how it works, why it works, and statistically how long you can expect to actually hold a position. And some of the things that I have discovered over this is that a lot of times, if I've held a position longer than 3 days, it's going to be a loss. There's only one exception I found, and that was held for 8 days. That turned out to be a profit. There are a few cases that made it to 5 days and turned out to be a profit, but typically speaking, after that, it's very rare to get profitability after you hold a position for longer than 5 days. So that's an interesting little dynamic that this research now shows. that I really didn't expect to see when I was doing it. So let's go down to the results. Total of 35 trades, 33 winners, 2 losers. And I made a profit. I made a profit of 28 cents. And the total running duration of this trade was 62 days and 11 hours. So it took me 62 days to make 28 cents. And this is the 1 hour time frame. So this also puts into context exactly how long you're going to be trading for your profits, so you can pick your budget and your balance appropriate to that duration to make the time that you spend worthwhile. So let's go and let's find another situation. Let's look at a 1-to-1. 1% take profit, 1% stop loss. And let's see how that actually looks mathematically. So my reward to risk ratio is 1, and my win to loss ratio is 1.01. Anything below 1 means you lost money. Anything above 1 means you made money. So we see the table. Let's get right into the details. Very first trade was a stop loss, and we lost 27 cents. Then we started with a take profit, another take profit, another take profit, and then a string of stop losses. And you see exactly how long it took. 4 hours, 4 hours, 12 hours, 6 hours, 4 hours, 3 hours, 1 hour, 1 hour, 1 hour. So you actually get a sense of just how long the trading will take for a position. And this is, again, a 1 hour time frame. So let's go to the results. And you see I did quite a few trades here. So for this particular example, I took 320 trades. I won 161 of them. I lost 159 of them. Altogether, I lost $9.62 days. Not very good, to be honest. So let's try a lower time frame. Let's see if it could be better. So let's go back to our time frames. Let's go to the 1 minute. This is a popular scalping. So let's see what a 1-to-1 looks like here. Well, not a lot of trades, but the duration is only 1 hour and 59 minutes. Excuse me, 1 day and 59 minutes. And it made 9 trades, 4 winners, 5 losers. And it lost 38 cents. So let's see what else we can see. Let's go see if we can find a 2-to-1 reward to risk ratio. Okay, here we are. 2% take profit, 1% stop loss, or a reward to risk ratio of 2-to-1. The win rate already tells me it lost money. It's below 1. I took 4 trades. I had 1 winner, 3 losers. Not good. So as you can see, these reports provide a huge amount of information. And you can go through and pick and find what aspects of trading for your particular situation you will feel most comfortable with in terms of your risk to reward ratio. So let's go see if we can. Okay, now you'll notice the numbers actually have gaps in them. For example, a 1 to 4. There should be a 1-5, meaning 1% take profit, 5% stop loss. It's not there because the system didn't make any sells. This only measures when an actual purchase and sell takes place. This is not about holding. This is about selling. Whether you make money or you lose money, because you're not making money if you're just holding. So let's go into the 5-minute to see if we can get some better information. Okay, here is the 5-minute time frame. And you'll see we have a lot more data. For example, 1%. Let's do a 1% take profit, 15% stop loss. Well, we have a reward to risk ratio of 0.07%. But our win to loss ratio is 8 to 1. So let's get right down to it. And we made money. $1.80. And it took us 5 days, 4 hours, and 55 minutes. So you can clearly see how that every trade we placed in this time frame was profitable. No stop losses. This is one of the biggest things that's taught quite frequently by a myriad of different professionals. If you use a stop loss, give it room to breathe. A tight stop loss means you're going to take more stop losses than you really need. There is a place for it, but most of the time you want to have some breathing room. And it's a matter of picking and choosing the numbers to support the asset you are trading. The only reason why you would want a tight stop loss, full well knowing that you're going to take more losses than you should, is greed. You need to be patient. You need to take your time. You need to think about the mechanical process of your risks versus your rewards. For example, here, a win to loss ratio of 4 to 1. It takes a stop loss. It takes take profits. And in the end, the stop losses actually hurt. 17 trades, 14 winners, 3 losers. But even though you're giving up some money because of the stop losses, only 3 losers. That is something that is worthwhile looking at in terms of sustainability. The more distance between your winners and your losers, the more sustainable your approach is going to be over the long term. And that is something you want to really think about. That sustainability is absolutely critical in being able to weather a market in any condition. When I downloaded this data and ran these simulations, I have no idea what the market's actually doing. It could be going up, it could be going down, it could be sideways. That's the whole point of these simulations, is to actually figure out what will work on a basis of a take profit ratio to a stop loss ratio and how that correlation actually connects. That is something you need to focus on as part of your risk mitigation and risk management. Now I've got data downloading into the system constantly, so it's updating all of these informations. And over time, more and more assets are going to be added into it. As I'm analyzing every single asset on the exchange with every single time frame, KuCoin has roughly 1,700 different assets on it. Over time, all of them are going to have a report in this list. And over time, I will be adding more exchanges with more reports specifically for a given exchange. Let me know which ones you want to see in the comments. That way I can add them to the list of what I need to scan on a regular basis. And now Oanda is the same way. We have a consistency of all of the assets and all of the time frames. The same rules apply as I described earlier. Let's go to the 1 minute candle. And now let's see. Now these numbers are representations of pips. From 5 pips to 100 pips for a take profit, and from 5 pips to 500 pips for a stop loss. Let's go find the one that I normally trade. The one that I have found the best results from, that personally fit my situation. A 5 pip take profit, a 200 pip stop loss. My reward to risk ratio is 0.2. It sucks. But my win to loss ratio is 7. And with Oanda, there are some slight differences we need to talk about. It pulls down and evaluates the margin of the asset, and it calculates the $1,000 base budget appropriate to that margin. So for this particular asset, at full margin, I have roughly $33,000 worth of buying power. And that will show up in my actual purchases. And as we can see here, every trade was a profit, and I took $3. So I have a duration of 3 days. So for 3 days, I made $3 of profits. Now through extrapolation, if you take 1 month's worth, I will have a $30 profit from this technique. And this is no intelligence. It's just buying at market price, holding it until I get a stop loss or take profit, and then getting back in the market on the next candle, no matter what the price is. If he was to actually apply an intelligent trading paradigm, this would probably be a lot more. But that's not the goal of this research. This research is just to evaluate the correlation between take profit and stop loss. For example, let's go to a more traditional approach, a 2-to-1. Let's go to okay, 10 pip. Okay, 10 pip and 5 pip. So a 2-to-1 reward to risk ratio. And our win to loss rate is below 1. We lost money. And we can see how that actually played out with the stop losses and the take profits. We can see just how many trades it took. It took quite a bit. So we had 81 trades, 32 winners, 49 losses. But the irony of this, the weird part of this, we actually made money. Think about that. We made money even though we didn't even make a 50% win rate. That is why these reports really help you fine-tune what you want to use for your numbers. This is profitable even though it's not above a 51% level. It's not something I personally would trade, but it's still profitable. So if you don't want to take a huge risk and you want a smaller position, having the variations like this can help you find what will work best for your personal situation. So a 2-to-1 risk ratio with a 0.65 win to loss ratio, and you made $3. Not bad. Not when you really consider that you're only risking 2% of your balance. Very small amount. The proper amount that you should be risking. So if you're not signed up in Patreon or a sponsor in GitHub, then you're missing out on a lot of data. Because as I continue to build this system, more and more of this information is going to be completed. So if you want to sign up, you'll see right up here, find my mouse, the sponsor button. You can click on that and it will take you to here. Now you can either sponsor me through Patreon or right through GitHub. If you go through GitHub, very easy. Pick a tier you feel comfortable with and you can support it, and then you'll be given access to all of this information. And even when it's updated, that access will give you all of the updates as well. It's because of the patrons and sponsors that I'm able to provide this research. Computationally speaking, it's expensive. It's brutal putting machines through this work, and it requires a lot of time and effort to get it done right. I've spent 2 years building this information, testing it, cross-checking it, making sure that the information is accurate and well represented. The process itself was a whole and complete framework just to be able to evaluate all of this information on a repeatable situation. And that really is what you are getting, all of this information. So if you're not a sponsor or a subscriber to Patreon, you're missing out on a world of wealth to help you improve your trading and help you get better advantages of the markets through real-world mathematical tests. Not hype, not nonsense, not get-rich-quick rhetoric. Real numbers showing real results that would provide you a framework and a basis point of being able to make informed decisions about your own trading. So, that's it for this video. Be sure you like the video and subscribe to my YouTube channel if you want more information or updates about this information. Thank you for watching.